Welcome to Code and Concrete, the leading podcast for prop tech, conversations about the built environment, and other exciting innovations. If you learn something new, please consider following and leaving a positive review. Enjoy. Hi folks, joining me in the studio today, I have Tyler Vinson. Tyler is the CEO of RE Tokens USA and RE Tokens Capital LLC, a FINRA member broker-dealer and alternative trading system, bridging traditional real estate with blockchain-powered securities. A real estate investor since 2002 and principal in over $100 million worth of transactions, Tyler holds a designated broker-dealer license in Series 7, Series 24, and 63 securities licenses. He's also an Amazon #1 best-selling author. That's pretty cool. Tyler is building the infrastructure to expand access to institutional quality real estate investments through regulated, tokenized securities. Tyler, thank you for coming on Code and Concrete.
Yeah, thanks for having me, Matthew. I always enjoy your insights into the industry and space and what you guys are doing. So honored to be part of your program here.
This is going to be an exciting conversation. Everyone knows there's nothing I love more than tokenized real estate. And I think that you guys at RE Tokens have a very unique approach because it's a regulated approach. You're playing by the book, and that's what this industry needs more of. But before we get into that, let's unpack you. Who is Tyler? How did you get into real estate, and how did this eventually transpire into Web3 real estate, tokenized real estate?
Yeah, so in my early 20s, I had a good buddy of mine come home from college, and I was selling sport boats and sport cruisers at the time. And he said, "Hey, a couple of my buddies are buying apartment buildings." He went to UW, so this was the Seattle area in Washington State. And I said, "Well, that sounds pretty cool." And ultimately, he drug me at the time to a couple of real estate investment educational deals, the ones at the hotel downtown that last a few hours, and then there's an upsell from there. Long story short, we signed up for the upsell. I called in sick to my previous job at the time, and we did the course. We got out of it. I'm going to date myself, but back then there was really only Carlton Sheets and Russ Whitney, maybe Robert Allen. There wasn't much. And this was one of those three, and it wasn't very good. So my buddy said to me, "Let's just go buy some real estate." And we indeed did. We went out and bought a couple of duplexes to start out. And once I dove in there, I realized I loved the sport of real estate investment and have done that now for about 25 years or so. When I shifted over to, digital real estate on the blockchain, tokenized real estate, and there's lots of acronyms we could go into, but was when somebody explained to me what blockchain was. They were actually building utility token at the time. I didn't know that's what it was, but a utility token for apartment complexes in the communities there. But with my real estate investment background and syndications, I instantly had the next 25 years of the real estate investment industry flash before my eyes. And I thought, wow, this is what I've really been waiting for, is the ability for more people to get involved in real estate investment, the ability to have a liquidity component for real estate, which is just so traditionally locked up. And as a professional real estate investor myself, I experienced that firsthand, both the lack of liquidity, when you have millions of dollars of equity on paper, but you either have to sell the asset or go to the bank and do a cash out refi to access it as the normal method. Um, that makes it illiquid for the most part. And then I would run into folks that, whether they weren't accredited, because I was only doing accredited investor deals at the time, or whether they didn't have the dollar amount, they weren't really able to participate in the real estate investments that I did. And so immediately I decided that I needed to get involved with being part of the change here.
Before we dive into the state of the industry and the maturation of the technology, which I think you can speak pretty well to, you've seen this industry grow a lot. Let's set the stage. What doesn't work in real estate right now? What's the root of some of these problems that you mentioned such as the high barrier to entry, the high ticket price for getting into investment deals, or some of that liquidity. And then we'll transition into how the technology has come about to solve some of that.
Yeah, so there's two sides of the token, pun intended. The first side is for the real estate owners. These are, you can call them GPs, sponsors, and or syndicators, right? And the issue here is what I just explained, where if you own a stock or more recently you own crypto, some of these assets, and you wanted to sell or gain leverage on them or something like that, there's quick, easy ways to do that. They have liquid markets, for example, but not in real estate. Not only for the GPs or syndicators, but for the LPs or the investors that invest in them. When you invest in a real estate syndication, traditionally you're locked into that deal for often 5 years, 7 years, 10 years. I've heard of 20. There's really no necessarily end in sight. And so that's just a cumbersome vehicle for investment, if you will, for both sides, meaning the GP or the active investor and the LP or the passive investor that are in these investments. So unlocking liquidity there to add flexibility, and I'm sure we'll get into that, but that is one of the problems that needs to be solved. The capital can't move with any type of velocity, has very little flexibility, and you're just kind of in there, and everybody's along for the same ride, depending on what that syndicator or general partner chooses to do. So that's one problem that we're out to solve. And the other side of that is not only access to these type of securities or investments, but the flexibility in choice of how much to invest, the choice of what to invest in, or choice at all. Often you have to know one of these syndicators or investors, and you might look at a few deals here and there, assuming you're accredited. Because on the access side, part of solving that problem is being able to get more people involved, and that includes non-accredited investors. And that's a big part of pulling our heartstrings and allowing them access to, like you said, some of this more institutional quality real estate. So allowing them to participate and use real estate as a wealth building vehicle is the other side of the problem that we're addressing.
So, somewhere along the line, and we can track it back to nearly 10 years ago, people said we can start to use blockchains or decentralized ledgers to ease the burden of handling the cap table, distributions, finding new investors, handling liquidity. But this industry has grown tremendously over those 8, 9, 10 years. And the initial use cases don't look anything like how the platforms are operating nowadays. So what would you say over the course of time has matured? Because 9 years, we can't really say that the industry is early anymore. So what's locked in, what's mature, what is solid infrastructure in tokenization right now? And then if you want to answer, what do you think we still need to work on in tokenized real estate to address these underlying problems and to address the industry to have scale?
Yeah, a lot to unpack there, but I think I'll start with the Jobs Act. And that even goes, pre the 10 years ago of what you were talking about, because that really changed the way that people could raise capital. And I think that set a lot of the foundation for where we're at today, even though that was several years ago, approximately 2012, I believe. But that's, in my opinion, what kind of unlocked the gate, if you will. And then to your point, blockchain came onto the scene as well as other technology. So it's just not the digital ledger or blockchain that really unlocked all of this. It was not a magic pill. A great tool for sure. But what you saw 10 years ago was a lot of like initial coin offerings where people made the mistake of saying, oh, now that we have this blockchain and we can create these tokens or coins, really, back then is what they were mostly called, we can raise a bunch of capital and we can sidestep all of this regulatory red tape. We can sidestep that environment. And of course, if we look back, those of us in the industry know how that went. It really blew up, and not in a good way. So I think in the last 10 years, there's certainly been more of a focus when we're talking about securities like we are today, or a lot of RWAs. There's been a lot of focus on regulation and compliance because it really starts there for real estate security tokens anyway. And in addition to blockchain, there's been a lot of other technological developments. There's been softwares that have come out. There's been a lot of new players in the space, vendors, digital custodians, digital transfer agents, wallets, right? These digital accounts that we can hold money and assets in. And so all of this is developed, and it's been our job in the industry to learn how to properly put these together so people can use them in the real world to make their experience better, and in this case to make their investment experience and opportunities better.
So that being said, what do you think is the weakest link right now? The technology's come a long way, but we don't have trillions on chain.
Yeah, we don't. I mean, I think in the first place, it starts with education, right? When we talk about tokenization or blockchain, instantly people dive into what is that? What does that mean? How does it work? And I make an analogy a lot of times with this, that folks really don't need to understand how the blockchain works to be able to invest in a real estate token, for example. Now, there are aspects, technical aspects that can be important, but it's similar to the internet where you don't really need to know how the internet works to get on a website and purchase something, right? You want to know that the internet is secure and all of those things. But I think people really tend to overcomplicate tokenization. And for your listeners, in case they aren't sure about that or are overcomplicating it, I like to oversimplify it a little bit and say we're simply making the ownership digital. So when you do a syndication, you have LLC ownership units or shares. When you add a digital component to those, and then we put it on the blockchain, that's really in its simplest form what tokenization is. And so I think that people tend to overcomplicate that. So the education is a big one, right? Understanding, at least in my world, that fundamentally this is still real estate investment. And that requires the same fundamentals you would have in normal real estate investments or normal capital markets. And so we're still putting those pieces together, right? Where we can go from really manually underwriting these deals and verifying the information and data to bringing that all into a digital, more automated arena where people can have a little more trust in what they're reviewing to be coupled with the educational piece. So it's moving quickly. Most of the infrastructure is put together, but there's still a long way to go in that. Not only the data piece that I just discussed, and I know you're a big proponent of that as well, but think of like leverage. There's in the future, near future, I believe. In fact, we're having conversations like this that you'll be able to get loans against these security tokens, right? And there's other expansion features in this digital piece that are not really fully part of the ecosystem yet. So I think that those are some of the preview coming attractions.
So it sounds like a lot of the Web3 oriented technology is fairly robust. We have great wallet solutions, there's marketplaces, there's smart contract service providers. A lot of that exists. It's where it clashes with legacy systems, the way that real estate operates nowadays, how that is underwritten, how that's processed. So there still needs to be a stronger connection between those legacy systems, pieces of software, the people involved, the stakeholders, and then how they can integrate that with the more deep tech, the more cutting edge stuff. There's another thing I want to touch on, though, which is really unique to RE tokens, and that's that you went right for the regulated route. You said people are using this technology inappropriately or trying to bypass existing regulation. You don't want to operate that way. You're going to play by the book. And so you have, I believe, this broker-dealer license as well as what we call a regulated ATS. Let's unpack both of those items and why they're really important in the conversation around tokenization of real estate? Because the whole thing is not just tech. Some of it's underlying asset, a portion of it is tech, and a lot of it is actually regulation and compliance. So let's dive into that. What's your approach? What licenses do you have, and why are they important?
Yeah, our original approach was not to be a FINRA member broker dealer and to not have an ATS. When I first got into the space as a real estate person, I was just excited to teach people about what the future of real estate investment was going to look like, and that making the ownership digital or tokenizing it was really the first step. In fact, at RE Tokens, our original mantra was secondary market ready. But something we've kind of alluded to is the industry, and people make this mistake all the time. It's starting to get a little comical for those coming into the industry now, where they're like, "Oh, tokenization creates liquidity. Yeah, tokenization. It now your assets liquid, and you can do this." But it's been a lie, quite frankly. So when we got in, I'll just tell a personal story. I tokenized a Class A storage facility I own here in my own hometown, and I couldn't wait to get it on an ATS and start trading it. That's the dream, right? That's the promise that the industry made. So we interviewed some of the bigger names out there, and the entry barrier to list on their ATS was enormous, not worth my little $7 million project. And so we decided to look for alternatives because we knew we needed to deliver this marketplace, this actual pathway to liquidity for our clients. It's one thing to tokenize it and give them a platform and educate them, but then what? You need the full ecosystem, which is the back end ability to trade secondarily. I think that's really the hype that the market gets. So there was a ATS, a broker, digital broker dealer ATS that we approached, and there's not many out there in the United States. And we had some great conversations, some nice people. And I said, great, let's go ahead and put my tokenized storage facility on the ATS. I want to start trading it. And they said, okay, that sounds good. How do you want to do that? I said, what do you mean? How do I want to do that? It's tokenized. Like, what, don't you do this? And what I realized is, short of a couple of those bigger names with the really high entry barrier, there wasn't the type of integrations to where they could just list these tokens. And so, we went through a season of looking at strategic partnerships or even acquisitions and different things, all in an effort to service our clients, to fulfill the promise of a pathway to liquidity. Because even listed on the marketplace doesn't guarantee liquidity, right? But let's at least start with the pathway to liquidity, where you can actually get it on a regulated trading platform. And when we realized that for what we wanted to do, real estate is a specialty, designing it for Main Street, but having Wall Street type infrastructure, that we had to really create our own. We wanted it to be specific for the real estate investment industry and real estate. We wanted to be able to integrate the digital economy. So you could use Bitcoin and stablecoin and these types of things to invest in real estate tokens. And that requires that to be approved in your licensing. And so once we looked around and decided against some of those other options, we decided to bite the bullet and hire a fantastic team of attorneys and digital asset executives, securities license executives. And we went and got a digital FINRA member broker dealer and SEC operated ATS licensing federally, and then got licensed in all the states and all of that, which is a pretty enormous lift. But it's all in an effort to try to bring this promise that the industry makes of liquidity to life. And when you look around and nobody else is really doing it, then you've got to do something. And so we chose to move forward with those licenses because there's a lot of tokenization platforms out there. And even the way we operated when we weren't licensed is we would tokenize it, right? Use the legal documents, the securities documents from the attorney to tokenize it, and we would prop it up on the platform. But we couldn't participate in the capital raising because we weren't a broker dealer. We could just kind of put it on the website. And then certainly we couldn't facilitate any type of secondary trading. And so the secondary trading, or the ATS, has rules to do it. So in real estate, we are normally operating with something called a Reg D 506C. I think you just mentioned that to open this question. And I think Reg A plus Tier 2 is coming, but I'll shelf that for a second. So what a Reg D 506C is, for some of your listeners that don't know, is it is an exemption to full registration with the SEC. It's the ability to raise capital for an investment, to recognize it's a security, but if you follow certain rules, Reg D 506C exemption rules, then you can do that. Well, the secondary sell of these securities has an exemption as well, and that's called Rule 144. And under Rule 144, to be able to resell, you need to do it through an SEC registered alternative trading system, or an ATS. And so that license is required. And if you're going to do tokenized, the digital license is required to be able to facilitate this secondary trading in a compliant way. And so that's why we had to get those licenses. The firm gets firm licenses, and then I had to go out and get a 7, a 63, and then now a 24 to be able to step in as a CEO principal of that broker dealer. So there's kind of the long-winded answer on why the licenses.
So in large part, it was imposed upon you, but it is the appropriate way to go about it, because a lot of those investor protections exist for very good reasons. Some of them need to evolve for the modern era, but they exist because when entities have not fulfilled their fiduciary responsibilities, people lost. And so having that badge, it is a badge of honor to be regulated and say, we are doing this appropriately. That should build confidence in investors. They should be looking towards platforms that are demonstrating adherence to the rule books, if you will. And it creates a sort of regulatory infrastructure that's sort of abstract. But if we want a big playing field, lots of trading activity, money moving confidently, you need to have a strong substrate of rules, standards, expectations, and then accountability when that's not met. And taking a step back, what should be increasingly obvious to folks who are tuning into this conversation is that there's tons of variables that lead into a tokenized instrument trading. And in fact, each step is very contingent on the previous step being performed correctly. So let's start with the basics. You have the real estate asset. Is this owned and operated successfully? Was it underwritten appropriately? Do we know a lot about that? Is the data present? What's the price? How is this changing over time? And then any sort of software and systems wrapped around that. What's capturing that data? Then you get into the financialization of that. Who is helping to capitalize this? What is their brand? How well are they known? What terms are they going to offer us? Then what technology is being applied in order to handle the capital markets portion of that? Because you actually have to create an instrument. You have to file paperwork, and you have to determine the dynamism of that instrument. Is it just a PDF that's been registered, or is this something that is going to move between investors? And then the Web3 components, where is that being custodied? Where is that parked? How do we record that? How do we report that back? How do we ensure that it's not in the hands of someone who shouldn't have invested in that asset? And then you have this governance layer on top of that, which was every step along the way done so in the accordance with state and federal laws? So there's so many moving parts. I actually don't blame us for not having everything figured out after 8-9 years. This is very, very complex. Everything from construction to real estate to capital markets and banking and technology and regulation. It's quite the puzzle to piece together. And now, the kicker. I want to talk about liquidity, because liquidity, in order to have it successfully, you need every step that we just went over to be working synchronously. Like, We know the price of the asset. It's compliant to trade. The technology, the marketplace exists for us to exchange. There's demand for this, and there's a large population of buyers. So let's talk about, how do you think that we will spur additional liquidity in real estate rather than a promise? What do we actually need to solve along the way that hasn't been yet to receive real liquidity in real estate finally?
Yeah. Well, I mean, first things first, we have to have a lot more quality assets on chain, right? If there's not product on the shelf, then there's nothing to invest in and buy. So I think it does start there. As far as the liquidity for these assets and for these investments, I think there's two buckets here. One is a retail bucket, and one is more of a professional investor or institutional bucket. On the retail bucket, a lot of it is education. They typically are not going to go to the depths of an institutional or professional investor, but they still need to know what they're investing in, how it works, have access to the data to be able to see that, is what's being presented, how is it performing, and all those things. But there's been such a lack of access to real estate as a wealth building vehicle for most people, that there's some fundamental real estate education that needs to be done there. That, as well as just allowing people to know or passing along the information that, hey, things are different than they used to be. You are going to have this access. You will be able to invest as little as $1,000 or $10,000 at a time, which really hasn't existed. You will ultimately be able to diversify in a whole new way. And what does that mean? Are you looking for assets that have cash flow or that have strong equity upside? Or do you even know what depreciation is or accelerated depreciation? And is that something you want in your portfolio? Those are actually very basic things in the real estate investment world that I think the retail investor who's not used to investing in real estate will need an educational path, because it is the adoption curve that we're looking to push. On the institutional or professional investor side, they understand a lot of those things. So I think at that point, it does become what kind of information to easily be able to underwrite and verify what's going on with this asset is available. And there's things like third party ratings that will come into this space. Again, conversations that we're having now, and to be able to rate these assets for institutional or professional investors, of course, you're going to need current, accurate, verifiable data in the stream of the ecosystem and what's going on. Because if these chief investment officers, for example, have to spend a bunch of time and effort into verifying this, or in the past they weren't dealing with a broker dealer or an SEC registered platform to get into these. I mean, they still do. The traditional real estate world was out there, the Wall Street edge of it, but not really for Main Street, and not really happening online. And so I think the standardization of how we package and put this information together, and the ability to verify the data and the asset, makes their job a lot easier. So not only can they complete the fiduciary duties that they have to their investors to ensure that they've done their due diligence, they're working with, let's say in this case, a broker dealer that's gone through that due diligence of the asset, that understands the compliance. Because even in that Rule 144 that I was talking about, you have to have a lot of that data, financials, historical compliance, information on the sponsors or the GPs. All that needs to be public facing and available and current to keep that deal compliant, and have it be able to trade on the secondary marketplace. So when we talk liquidity, I think we got the retail investor and the institutional investor. And although it's ultimately the same thing, that latter system that I described, they both have different angles they're going to come in on it, to where the retail is going to want to know, like, okay, why should I invest in real estate, and what are the differences between these investments? And the institutional or professional investors are going to want to know, okay, yeah, we're already in the real estate game and sold on that, but how do we know what we're investing in from a compliance level, from a data level, from a current financials level? And so as we get those things mastered, you'll see more liquidity come into the marketplace.
Now, some listeners might be wondering, what is the role of the government in all of this? And if we take a step back, we mentioned that a lot of these fundraising efforts, or what might be circulating, are exemptions. They're accessible to investors because we filed paperwork to make it exempt from typical SEC filing. So now, if that's the case, what role does the government or the SEC actually have in supporting these deals, in verifying them, and ensuring integrity? And why is that? Because we keep talking about an investor's ability to perform diligence, to perform verification. How does that differ when there's an exemption at stake rather than like a publicly listed company and me going to an Edgar database and seeing what happened in last quarter's earnings?
Yeah, great question. There's kind of two buckets to this as well. One is for the issuer themselves or the GP sponsor who we've been talking about, and what they have to do and follow as an exemption like a Reg D 506C. So that is a private placement. So they just are filing something called a Form D with the SEC. And although that's not a full filing like the public securities that you mentioned, what it is basically letting the SEC know, hey, this is who we are. We're going to raise money for this particular thing. Let's get on your radar in case something happens and or somebody complains or we don't do this right. You know what we're doing. You know how to find us. You know kind of what is set up for us. Because if you don't file that Form D in this circumstance, and you're raising capital for a security, which most people don't realize it almost always is, you've got a big problem on your hands because there is a proper way to do this. The oversight of the government here is investor protection, full stop. Full stop. It's about investor protection as it should be. And so, they want to make sure that, hey, if you're going to raise capital, we want to know who you are, and at least the basics of what's going on. They don't approve it or do anything like that, but they just want you to be on the radar. And if you file this exemption, this Form D, it says there's a set of rules that I'm going to follow. And if you don't follow all those rules, you can lose your exemption, which means, of course, that you're basically illegally selling securities. And that's certainly not a world that you want to be in. And there's the issuer side, but then there's the investor side of that where, let's say, and we keep talking about a Reg D 506C, so that means accredited investors only, the C part of that regulation. So you're going to need to make reasonable assessment that they are accredited. You're still going to have to follow KYC, which is a know your customer, to know who those investors are, as well as the rest of the rules. The other bucket is the broker dealer bucket, and that is far more intense because what they're saying is, okay, it's one thing to have kind of the issuer principal do it. It's another thing to have it a professional that the public perception is that they trust because of the licensing and regulation that they have. So when you talk about audits and exams and all of that, we go through that as a broker dealer. That's regular course. I mean, it is extremely stringent to be a broker dealer and to have an ATS with the reporting and stuff like that. So for us as a broker dealer, same, it's full stop, protect the investors. And what that looks like is when an asset wants to get listed on the platform, so let's, even if it comes straight from their attorney with all the proper legal documents and security packages and stuff, we still put it through another attorney firm in due diligence. So we can do bad actor checks and see who are the sponsors, who are the GPs, who are these people, what's their history, what's their resume, where are they from, Do they meet all the Reg D 506C? Does all of their marketing material match their disclosures? PPM, private placement memorandum, is a key disclosure in the security documents. So what does that, look like? Are they expressing all the different risks that are involved here? Because the problem in lies where if something goes wrong, right? So not only is this investor protection, but now that we get to this point, before we flip over to what the investor has to do, in a way, it's really protection for the issuer or the GP as well, in terms of if they have an investor that just decides they didn't like the investment, or maybe they lost money and they're not happy about that, and they want to file a complaint with the SEC. Okay, then they're going to come in and take a look and say, did you make these proper disclosures and let people know what all the risks are in this? Did you let them know that they can lose money in this investment? Did you do all of these things that are involved in this safe harbor exemption? And if you did, you're going to be in a much, much better spot than if you didn't, or there's discrepancy there. So we take them through that complete broker dealer due diligence. And then on the other side, any investors that invest into these deals go through a similar process. They go through that KYC, know your customer, or KYB, know your business, which is identity verification. There's suitability often involved, especially with the accredited investors. Is this a appropriate investment for that investor? There's accreditation verification to make sure that they are indeed accredited if they need to be in these primary offerings. Is the LLC that they're using, all of these things to make sure that that part is taken care of. And then the whole platform that we're trading on all has to be compliant with FINRA rules and SEC rules as well. So you've got the players that need to be checked out and the diligence done, the verification, all of that. But then the playground that we're all playing on is overseen by FINRA and the SEC as well. So they want to know that there's safety mechanisms in place, if you will, that somebody can't just, get on and hack right in and somebody loses all their money. There's different types of testing and things like that that are involved with the infrastructure, that Web3 infrastructure that you're talking about, because we had to build and put all of that together. Everything I just said needs to be connected, and it also needs to be connected and integrated with the transfer agent for trading. It needs to be connected with the blockchain, the custodians in those custodial wallets, the ATS if we're doing secondary trading, because that trade needs to happen right now, simultaneously, as you said before. And so they want to know about all of that and understand it to make sure that everybody's staying in their lane.
Well, despite being a private market, it's still substantially regulated. It has constraints. And I don't want to take us too far off course, but for listeners who maybe only know public markets because they have Robinhood and they've invested in Apple, do you want to take it one step further and say how everything you just described is different than public markets? Like, where do we draw the line in the sand?
Yeah, so there's different regulations, and when somebody files for, say, an initial public offering, or they're going to go public, it is a substantial disclosure process. I mean, you're talking about probably 20x the documents and pages. And instead of just being on the SEC's radar, the SEC is actually going to go through all of those documents. Again, they don't approve anything, but they're going to review it and make sure that it sounds like a viable investment product for the public. And that's an enormous amount of disclosure. There's also much deeper financial audits and things like that. In the Reg D 506C that we talked about, there's not like a deep financial audit there, like there is with a publicly registered company. There's kind of a hybrid in here, I'll just mention for the listeners, called a Reg A plus Tier 2. They call that a mini IPO. And that's kind of in between a Reg D and a full public offering. But to your point of the difference of public markets, they're going to go through that deep disclosure, the deep financial audits, the SEC review of all of that information. They normally have investment bankers involved and legal opinions that are written up regarding it. And so a far deeper, due diligence and a far deeper disclosure, because they know that all the public's going to read those, 20,000 pages of disclosures and everything like that. I'm kidding, but to know that that's kind of the framework, as you mentioned earlier, generates kind of inherent trust. And then they're also trading on regulated platforms like New York Stock Exchange or NASDAQ, and all of those are regulated as well, similar to kind of that ATS regulation I was talking about.
And one thing that's interesting that you mentioned is you were explaining how documentation is produced by these issuers. It goes through their legal team, it goes to the broker dealer, and really there's no canonical record of data. So when you move things through the SEC and there's audits and then there's the EDGAR database, that creates an authoritative copy of that information. Like, this is the final version, this is what everyone can view. Versus in private markets, there's versioning issues, there's overlap. Two documents could have different truths, and that needs to be reconciled. And then it moves between parties. And so maybe some of the data's portable, but the trust is not. And I think that fragmentation that exists and the lack of standardization in private markets is a huge problem for tokenizing real estate at scale. Because if you were to dissect real estate even further and what it takes to actually appraise an asset and look at its performance over time, and then you're trying to consolidate that, get that to the finance team, then get that to the broker dealer, make sure everything's up to date. And there's not this level playing field of trust. There's not inherent trust across all broker dealers. Now, you would assume so because they're all regulated, but authority in one jurisdiction may not pass over to another. And so again, if you don't have this single source of truth between different private market entities, different marketplaces, different trading systems, are they pulling the most recent data? Where did they source this from? Who was the responsible party? That's where the markets create or obtain a lot of friction versus these massive exchanges that are very uniform. They're very synchronized, and they're working from the same data sets, versus private markets struggle with that. It's real estate especially. We've seen some efforts to aggregate what we call real world asset data and make sure everyone's looking at the most recent token price and the transactional history and what we know about the underlying asset, but it's still hyper fragmented in that way. So I think standardization is, if not regulation, standardization is going to be one of the turning points for the industry. And now with artificial intelligence, the ability to quickly process large data sets and say, yep, looks good, it's the same, this hasn't changed, this looks non-compliant, flag that, and then speed up that processing of data. It's going to make all the difference. Versus, in the government, there's huge bodies of people who do this, teams and teams and teams. A small offering doesn't have that. So AI is going to be a huge tool for replicating what a typical public company might have in terms of human capital and resources, I think. What do you think?
Yeah, I think you hit the nail on the head when you talk about the friction that's currently there for something like a real estate token, a real estate security token, because so much of that process is manual. And yeah, you need to have the most current legal docs. And if you're going to front face information, you need to have the most, current information. But to your point, it's fragmented. So you're having to go get that data regularly, or in case of legal, if there's any changes, and make sure that you have that. To where I think technology and what firms like yourself are doing are going to help automate that, and that reduces not having the appropriate data and some of the overlap. To your point, do you have last year's appraisal or this year's appraisal, right? Do you have last quarter's NOI, net operating income, or do you have the current quarter's net operating income. Things like that I think are important, and especially in real estate, uh, things like vacancy rates and stuff like that fluctuate are going to be things that investors really want to know as close to real time as possible. When you're operating off really old data, I'm analyzing. I still invest in real estate, and I'm analyzing another storage facility for acquisition right now, and all the data is 3 months old. And although I can like use it, I'm still going to have to get all the new data, review it all again, and go through that. I'm going to have to kind of piece it in and manually put it into my stuff, even with using AI. And so I think being able to have a congruent system that keeps that stuff in more of an automated, accurate fashion is going to be critical. It's what needs to happen. It's I think really where we're looking to build and develop in the industry right now. I mean, you would know that as well as anybody, but that's how I feel about it.
Yeah, 100%. Well, I want to offer you a call to action, RE tokens. And am I saying it right? Is it RE or do you say re tokens?
Thanks for asking. RE tokens,
All right. And
RE for real estate,
yes,
obviously.
yes,
Yeah.
I was going to say RE for real estate. If people didn't pick up on that. So where you guys at as a company? How are things coming along? Any milestones we should be looking forward to in 2026?
Yeah, we've got some exciting stuff. If you go to retokens.com, at the top there's a button for the marketplace, and you can actually go in and view live tokenized real estate offerings that we have right now. So that's a pretty cool feature that's available. We do have a lot of education there, so we often send people to retokens.com. And the ATS is something that's done. It's built. We're ready to roll, and we're looking for a few awesome real estate projects to trade on that. So as part of that Rule 144, so people know, you have to have 12 months of seasoning to list on a secondary market on the ATS to sell secondarily. And so that means that you've raised capital under a Reg D, 506B or 506C, and it's been 12 months since you did that capital raise. Now you can come list on the ATS and open up that liquidity pathway for you, your community, maybe some of the bigger syndicators that have large YouTube followings and things like that are able to now allow their community to participate. So there's some exciting 2026 stuff, and really right now we're talking with folks to be able to launch the ATS with some great projects. So that should be within the next couple few months as these projects come in. But if you want to just learn more about what we're doing and our insights, kind of the latest and greatest in the space from our lens, I would recommend following RE Tokens on LinkedIn. We've got a company page there that we regularly put some information and thought leadership on. And then we've got a great YouTube channel, which is just at RE Tokens on YouTube. And we put a lot of content on there as well.
Fantastic. I will include links to your social medias and your website in the show notes so people can scroll down, get involved, see what's on the market, do a little shopping around, maybe invest in real estate if they qualify. We're not going to do a whole disclosure read off here, but double check. It's
Yeah. The disclosure is important, so we'll put one in there. But yeah, this is not an intention to sell securities on here. We're not giving investment and legal advice, educational purposes only, right?
yes, now we're protected. All
Yeah.
right. Wonderful. Well, this has been a fantastic conversation. I think a lot of real estate tokenization discussions skip over the regulatory portion. It's less fun to talk about, but it's extremely important. And there is a lot of nuance. You have to do it properly. You have to understand what you're doing. And also the contingencies and dependencies. As we mentioned, there's different variables in this. So you can do one portion right, let's say the primary issuance and offering, but that doesn't mean that you're ready for a secondary market. So it's really good to check all the boxes and stay compliant across the life cycle of the property and the deal. And that's going to lay the foundation, as I said before, regulatory infrastructure. We can build on top of that. The government's behind us. And now we can really let this market grow, prosper, and let millions, billions, or trillions transact. All right, Tyler, it's been a great conversation. I'm sure our listeners enjoyed it as well. And if they did enjoy it, I invite them all to leave a 5-star rating, thumbs up on YouTube, or subscribe. I'm wishing you all the best in the meantime, then.
All right. Thanks for having me, Matthew. It was a pleasure, and look forward to future conversations.